Somewhere in this country right now, a 71-year-old man is standing on land his grandfather cleared with a mule, and he does not own a single acre of it anymore. Not because he gambled it away, not because he drank it away, not because he made one bad decision on one bad night. He lost it because he did exactly what the bank told him to do, at exactly the moment the bank told him to do it, and then the rules changed while his signature was still wet on the paper. That is not a story about farming. I need you to understand that before we go one sentence further. This is a story about what happens to a man who trusts the system completely, who follows every instruction, who never misses a payment, and who still ends up standing in a gravel parking lot watching strangers bid on his tractor. If you have ever paid every bill on time and still felt like you were losing ground, you already know this story. You are just waiting to hear it said out loud. Let me tell you about a man named Warren. Warren is 68 years old now, but in 1978 he was 31, and he was doing everything right. He had taken over the family operation from his father, 400 acres that had never carried more debt than a used combine could cover. Grain prices were good that year. The government was encouraging farmers to expand, to feed a hungry world, to borrow against a value of land that seemed like it could only go up. Warren's local banker, a man he had known his whole life, sat across the desk from him and told him this was the smart move. Not the risky move, the smart move. Buy the adjoining 200 acres. Borrow against the equity. Lock in your future. Warren signed. He did not gamble that money on anything foolish. He put it directly into the ground, into equipment, into the exact kind of long-term thinking that every financial advisor for 2 generations had told men like him to practice. He worked harder than he had ever worked in his life. He carried that debt the way you carry a mortgage, the way you carry a car note, the way you carry any obligation you fully intend to honor. And then the number changed on him. By 1981, the interest rate on Warren's variable loan had climbed past 18%. Not because Warren did anything differently, not because his land got worse or his work ethic slipped. A decision made in a boardroom hundreds of miles away, meant to fight inflation in the broader economy, reached directly into Warren's mailbox and rewrote the terms of a deal he had already kept his end of. His monthly payment did not go up gradually. It exploded. The same expansion that his banker had called a smart move became, almost overnight, the exact mechanism that was going to take his family's land away from him. Here is the part you need to sit with. Warren did not default because he was careless. He defaulted because he trusted a system that reserved the right to change the terms after he had already given his word. And when the land went to auction, the men buying it were not other farmers. They were investors with cash, men who had never touched a bushel of wheat, who understood that leverage cuts both ways, and had positioned themselves to be on the winning side of a rate spike they did not create either, but were more than willing to profit from. Warren lost the collateral. They kept the leverage. That is the entire story of who wins and who loses when the rules turn, and it has never once been about who worked harder. You need to hear this now, because it is not history. It is the blueprint. The early 1980s farm crisis is usually told as a story about weather and crop prices, and that telling is a lie of omission. The real mechanism started in 1979, when the Federal Reserve, under a new chairman, made a deliberate decision to crush inflation by driving interest rates to levels this country had never seen in peacetime. It worked, in the sense that inflation did eventually come down. but the tool used to do it was blunt, and it did not distinguish between a Wall Street speculator and a family that had borrowed in good faith against land that had been in that family for 3 generations. The rate hikes did not ask what the debt was for. They just called it in. Farmland values, which had been the collateral behind hundreds of thousands of loans just like Warren's, collapsed by nearly 60% in some states within a few years. The very asset the banks had encouraged farmers to borrow against became worthless as collateral almost overnight, which meant the loans became instantly mathematically impossible to refinance. Men who had never missed a payment in their lives were suddenly insolvent on paper, not because they stopped working, but because the value of the things securing their debt had been erased by a decision they had no vote in and no warning about. I want you to notice something about that decision. It was not made by a villain twirling a mustache. It was made by officials who genuinely believed they were saving the broader economy from something worse. That is what makes it so much more dangerous than a simple conspiracy. Nobody had to plan Warren's ruin specifically. The system simply was not built to protect him. His devastation was not the goal. It was an acceptable cost, calculated by people who would never once meet him, never see his kitchen table, never watch his wife go through the mail looking for the letter from the bank before he got home from the field. That is the mechanism. Now let me show you, it never actually stopped. The tool that liquidated Warren's family land in 1982 is the same tool sitting inside your mortgage, your credit card, your car loan, right now, today, while you listen to this. Variable rate debt does not care what decade it is. It does not care if you are a farmer or a man with a corner office and a company badge. It is a contract that says, in language buried on page 11, that the terms can change without your consent whenever the people above you decide the broader economy requires it. The name on the paperwork changes. The mechanism is identical today. Only the names have changed. Think about your own life for a second. Think about the last time a rate adjusted on something you owed, and you felt that small, cold drop in your stomach when the new payment number showed up. That is not an accident of bad luck landing on you personally. That is the exact same machine that stood in Warren's driveway in 1982, just wearing a different suit. The man who built that machine did not stop building it because it broke families. They kept building it because it worked exactly as designed, and it is still being fed by men who believed, the same way Warren believed, that following the rules meant the rules would protect them in return. Here is how the machine actually works, mechanically, without any conspiracy talk attached to it, because you do not need a conspiracy to be afraid of an engine that was built with your compliance in mind from the very first blueprint. A lender does not want you debt-free. I need you to sit with that sentence, because everything else in this script depends on you actually believing it. A debt-free man produces no interest, no late fee, no minimum payment, no ongoing leverage the institution can hold over him. He is, from the system's point of view, a dead account. So the entire architecture of consumer credit, your credit score, your available limit, your pre-approved offers, is not built to reward the man who owes nothing. It is built to identify, cultivate, and retain the man who owes just enough for just long enough to remain profitable without ever quite defaulting. You are not a customer to this machine. You are a yield. And a paid-off man generates no yield at all. This is where Warren's story stops being the only story, because the system does not only punish the man who trusts it too much with debt, it also punishes the man who trusts it too much with safety. Let me tell you about a man named Ellis. Ellis is 61 now. In 1987, he was 32 years old and working as a junior account manager, and he had done the opposite of what got Warren killed on paper. Ellis did not overextend on debt. Ellis was cautious. He put money into his retirement account faithfully, every single paycheck, the way every single financial voice of authority in his life told him to. He trusted the market. He trusted diversification. He trusted the phrase his broker used constantly, the phrase that was supposed to mean safety. It is spread across everything, so nothing can hurt you badly. On the 19th of October, 1987, the market fell over 22% in a single trading day. Ellis watched years of disciplined saving evaporate before lunch. And here is the detail that should make you angry on his behalf. The man making margin calls that morning, the man trading against falling positions with borrowed money and computer-driven speed, were not touched the way Ellis was touched. Some of them made money on the way down. Ellis, the cautious one, the one who did everything by the book, took the full weight of a system that had told him diversification was armor, when in reality it was just a wider net for the same fall. Warren trusted debt because the bank told him to. Ellis trusted the market because the advisor told him to. Different decade, different institution, same outcome. The man who followed instructions lost. The man who understood the mechanics behind the instructions did not. That is not two unlucky men. That is one design tested twice. Here is the part that should make you angry. The financial industry does not primarily make money by helping you get rich. It makes money by managing the relationship between you and risk, and it has a structural incentive to keep you exposed to that risk for as long as legally possible because your exposure is its revenue. Warren's bank profited from him carrying debt right up until the moment it profited more from foreclosing on him. Ellis's advisor collected fees on his account whether the market went up or down. Neither institution was rooting against these men personally. They did not have to. The system simply does not care whether you survive it as long as you remain inside it. Here is the part that's going to make you uncomfortable. The posture that actually protects a man from this machine has almost nothing to do with strategy and almost everything to do with need. A man who needs the bank, needs the market, needs the next promotion, needs the next refinance, is a man the system can move. A man who needs nothing from any of them cannot be moved because there is no lever left to pull on him. That is not a metaphor. That is math. The system's entire power over you is proportional to how much you still need from it. This is also, if you have ever wondered, the real explanation behind something you have probably noticed and never been able to name. You have met men, maybe your own father, maybe a man at church, maybe a man who sat quietly at the end of a bar while louder men performed their success around him, who commanded a room without raising his voice once. Everyone read him as calm. Everyone read him as dignified. What you were actually reading, without knowing it, was a man who owed nobody anything and therefore had nothing to prove, defend, or protect in that room. His composure was not a personality trait. It was the visible outcome of an invisible balance sheet. The quiet authority and the debt-free posture are not two separate qualities. They are the same fact, seen from two different angles, and that is exactly what has been stripped out of view for the last several decades. Somewhere in the shift from a man's word being his collateral to a 3-digit score deciding his worth, the entire cultural machinery around earned trust quietly went dark. It was never announced. It did not need to be. A generation of men who required nothing from anyone were simply less profitable to market to than a generation of men who could be convinced they needed everything right now, on credit, before someone else got it first. I want you to think about what that means for your own life tonight. Not tomorrow. Tonight, the next time you lie awake, doing the math on a balance you already know by heart. The man who owes nothing is treated like a curiosity by a system built entirely around men who owe something. Ask anyone who has tried to rent an apartment with a paid-off truck, a cash-bought house, and a single debit card, no credit history to speak of, and been denied, not because he was a risk, but because the system had no file on him at all. The absence of debt reads, to a machine built to measure debt, as an error rather than a virtue. That is not an accident of bad design. That is the honest signature of a system that was never built to recognize a free man, because a free man was never the customer it wanted. So let's talk about what all of this actually means for you, because a documentary that ends on outrage and nothing else has wasted your time, and I am not interested in wasting it. This is not a script telling you to burn your credit card or bury cash in the backyard. It is not a call to abandon the system entirely, because that is not realistic, and pretending otherwise would insult you. What it is a permission slip to stop mistaking obedience for safety. Warren was obedient. Alice was obedient. Obedience did not save either of them, because obedience was never the thing being rewarded. Independence was. The less a man needs from the machine, the less the machine can do to him when the terms change again, and the terms always change again. That is the one guarantee history actually gives you. Warren is 68 now. He does not farm the 200 acres anymore. They belong to an investment group that leases them out through a manager who has never once walked the fence line. But Warren still lives in the county. He drives an old truck, paid for outright, and he tells anyone who asks that the day the auctioneer's gavel came down was the worst day of his life. And also, strangely, the last day he ever owed a single institution anything again. He rebuilt smaller, slower, entirely in cash on 80 acres. Nobody can call a loan on because there is no loan to call. He is not rich by the standard that ruined him the first time. He is untouchable by it now. And if you ask him which one he would choose, he will not hesitate. That is the whole argument, distilled into one tired, sunburned, honest man standing on 80 acres that belong to him and to no one else. Choose leverage, and you are choosing to be moved by hands you will never see. Choose ownership, and you are choosing to be immovable. Can't foreclose, can't margin call, can't repossess, can't recall. That's not luck. That's not privilege. That's structure, built one refused loan at a time. The rate did not care about Warren. It never once has to care about you either. The gavel does not fall on the man who owes nothing. It simply cannot find him